good afternoon and welcome to this week's Market Matters video update. It's the 10th of November today. We're going to talk about 6 stocks in total today. We're going to talk about 3 of the best and 3 of the pain points in the portfolios. We don't like to shy away from the painful ones, James, so we're going to kick things off there. What are the 3 stocks in the portfolios that are causing the most pain at the moment for you?
So we often write about, if you worry about your losers, if you address your losers, the winners will take care of themselves. So 3 losers across portfolios. Illumina, AWC, we hold it in both the flagship growth portfolio and the income portfolio. We're down about 15% on both. Capital Health is one in the emerging companies portfolio that you're going to talk about. And then IVE Group, IVE Group, IGL is a ticker for that. It was a really big pain point for us in FY20. It's been better for us in FY21 and it's had a good start to FY22 as well. So that's sort of a transition point. So, Illumina has been, and we've had a few questions coming through the pipe on Illumina. It's been weak. We're down about 15%. It's now trading down below $2. A few key points. We remain bullish on the stock. I think it'll do well over the next 6 to 12 months. Illumina prices have been a little bit soft in the last couple of weeks, and we've also had some swings and roundabouts around what's happening in China. The key thing to focus here is around spot alumina prices. Spot prices are north of $440 US a tonne. Current consensus is around the $340 US a tonne. So what that means is they've got a commodity price tailwind. If the consensus starts to move up, you'll get earnings upgrades and you'll have earnings tailwinds in that stock. So look, I know it's been painful. Stick it out for now. Patience can often be rewarded, and we think that'll be the case in Illumina. Capital Health, another one where I feel patience is going to be hopefully rewarded, Harry.
Well, it's got to be a patient stock. They've got such low debt at the moment. The balance sheet's in a great position. They've actually got a buyback in place that they extended for another 12 months quite recently, but they're not out there buying shares. That to me says that they're holding back some cash for potentially some acquisitions, and some news flow around the stock could see this thing push higher. So they're not really good at sort of flagging how they're going at the moment. Capital Health, they've been a bit light in terms of updates, but that doesn't mean that they're doing things behind the scenes. And I think them, conserving capital, being very conservative with that capital will be fruitful in the medium term. So it is cheap. You've seen IDX is probably their closest peer. That's rallied in the last about 6 weeks, whereas Capital Health sort of come off a little bit. That valuation gap was already huge before that performance differential there. So still cheap, still like it. We just need a bit of a news flow and a bit of a tailwind coming out of Capital Health.
So this is a diagnostics imaging business, largely focused in Victoria. We bought around 40 cents. It's down in the low 30s at the moment. Again, painful, but it does. The market, I think, was focused around acquisitions, as you rightly said, that they were going to make earnings accretive acquisitions. They've got cash on the balance sheet to do it. They haven't. That's not necessarily a hugely bad thing. Capital discipline is important, particularly in that smaller end of the market. So although it's down, we remain positive on Capital Health and reasonably happy holders looking for higher prices. And just IVE Group, which is this integrated marketing business. We hold it in the income portfolio and the emerging companies portfolio. It was our worst performer in 2020 by a long way. It's recovered in 21 and it's going well in 22. I just wanted to highlight this one because it's an example of why remaining patient can often be key. So going into the pandemic, obviously marketing spends gets cut. IVE Group runs a lot of capital equipment. They've just made a reasonably large acquisition. Their balance sheet was a bit stretched. They lost a large contract. All of these things sort of knocked them for 6 right at the wrong time around the pandemic. The market got concerned that they were having balance sheet issues. They were going to need to raise a substantial amount of equity. They didn't. They got through that, which is obviously, there was a bit of fortitude shown by management there, but they know the business pretty well. So integrated marketing is very much exposed to an uptick in economic conditions. So the Australian economy is performing very well, and that the outlook for earnings, I think, is going to get better into the rest of this year and into early 23. So it's on 8 times earnings, pays nearly 8% fully franked yield. We like it, maintain the positive view on IVE Group. Now let's get on to the good stuff.
Yeah, you mentioned positive view. Let's look a bit more positively now. James, the three best in the portfolios that you're really enjoying at the moment. I know there's one international stock that we haven't spoken a lot of recently, but that's had a really great week this week.
Yeah, I've done a few videos over the years on the Trade Desk. TTD is the code for that. They are they're an ad tech business, advertising technology. You think about streaming. You know, I watched Yellowstone last night. What a cracking show that is. But you think about all the eyeballs now on the streaming services around the world. These guys, they do that, but a bunch of other things as well about putting advertising in, online content, etc. But providing a lot of data and algorithms around how successful that advertising is. So they reported really strong top line growth at their quarterly. They said the next quarter is going to be a ripper. So you've sort of got to close your eyes around valuation on the Trade Desk and just think about the growth in the business. So revenue growth has been phenomenal. If they can continue to grow the way they're growing, that's going to drop down into really strong earnings growth over time. So you talk about this, we don't write about it a lot, but there's a concept called operating leverage that these businesses that have got reasonably high fixed cost bases, then they grow their customer base, user base, they've got huge leverage. So they look expensive for a time and they get cheaper as growth continues to come. The Trade Desk, it's all-time highs, it's expensive, but stick with it is my call on the Trade Desk. Altium's another one that we have written about, held for a while, and I just want to flag this. We're up a fair way on the position. There was a takeover from Autodesk a little while ago where they walked away from. It was interesting in the last week or so, Bell Potter's come out and upgraded from a hold $32.50 price target, which they downgraded the stock when Autodesk walked away, now to a buy and a $42.50, saying the strategic rationale for Autodesk still stacks up. We think that's the case. We've always thought that's the case, and we think there's probably more upside in Altium. So that's one that's done really well for us, but one that we're going to continue to hold. And you've got one that's been...
Yeah, one that's been a cracker in the emerging companies portfolios, Praemium, PPS. We bought them back in April, sub 80 cents. They're up around the $1.50 mark. They've done really well, incrementally bringing in more FUM, more FUA. They got over $45 billion in funds under administration not too long ago. There was a really good update. The stock popped on that. Soon after we had, they call it a merger. It looks a bit more like a takeover from Netwealth, offering a scrip consideration for Praemium shares into Netwealth. You think about these businesses, they need scale. They're going to have to acquire funds under administration. It's really good for them to go out and potentially buy businesses. Praemium is by far the cheapest of the listed names at the moment. Netwealth have come out and put their hand up, saying that they're interested in taking them out to sort of integrate that FUA into Netwealth's platform. And you get that operating leverage like you just spoke about, James. There, it's done really well. It's actually run through where that merger proposal valuation was. It was sort of the mid 140s. It's around 150. They're in the middle of selling their international business as well, which could create a little bit of havoc near term, but ultimately it's one of the cheapest of the platform names out there. Hub recently took over Class, and that was at a 70% premium to their last close. So, we're not talking maybe a 70% premium for Praemium. That might be a bit of a stretch, but the 20% they were offering, I think, was a bit light, and there is that strategic rationale for Netwealth to take out Praemium at sort of these levels. So.
Yeah, so Praemium have come back and said it's too low. We agree with that view from Praemium's board. We think a higher bid is likely either from Netwealth or someone else. Hub could potentially look at it, or an overseas player. So we're going to continue to hold Praemium as well. Really good update today, Harry. 3 stocks that have been providing us a bit of pain. 3 stocks that have been doing well for us. I guess the clear message is we're comfortable holding all of them for now. Of course, that can change, and we'll write about that when we do in the Market Matters reports. And obviously, as we always do, send alerts out whenever we're trading or changing in our portfolio. Have a great week. We'll speak to you next week. Bye for now.